we go again. It's like yesterday. So welcome to the 17th MathFinance Conference in Frankfurt. This is in fact the 17th time. I'm very happy to see you here, so we can again.
We had a great panel discussion about the future of quants in the industry and what are the profiles that we're looking for in new quants and how has this changed over time. I think the perception has been changed. There's a lot more about understanding risk better, not just the technical methods how to calculate it. And obviously there's a huge trend to simplify products, to simplify procedures, to make it more manageable. And I think we're going to see more of this.
In fact, in asset management, concepts like artificial intelligence or machine learning already have been used since quite some time. For example, the Black Letterman model uses a mixture between market implied data and investors' views, and mixes distributions with defined uncertainties. And I think that's a very, very important step towards developing, say, multi-step Bayesian networks that could work with a feedback loop and could do, say, automatic allocations and incorporating also new data that was not pre-scheduled. So I think there are great opportunities for machine learning in asset management indeed.
Of course we do, and it's not like do we still need them. I think we need them more than ever. I think this industry is going to transform. I think if we look at how banks are organized, it's still very old-fashioned. We're very slow in adapting new information technology and technology in general, and I think banks will play, and quants will play a big role in how this happens. It will be about data science, it will be about artificial intelligence. If I look at what we will do in the short term, it's mostly regulatory remediation. We have to reply to our regulators. We need to improve our risk reporting analysis, the dashboarding, how we present it. It needs to be faster. We will spend a lot of time on increasing the performance of what we do. There will be increased behavioral modeling for which we need quants, and I think we also understand that this whole world is very interconnected and there will be some quantitative work on that. I already mentioned data science. Data is going to be increasingly important. We'll get closer to data than ever. We'll expect our quants to believe their modeling world and really get very close to the data. We need more.
Looking around, I haven't actually seen any, which is a bit of a shame, particularly in view of the last talk that we had on the change from the measure of risk from VAR to expected shortfall, which is something the regulators actually required, and we just learned it actually doesn't make any sense.
Industry. The nice thing about having a partner like MathFinance is they bring all the knowledge of finance and they have it in their libraries, and our part is to bring this into the cloud. So it's not naturally given that you are able to develop software that makes mathematical calculations and also know how to bring this into the cloud. And this is what we do and what we showed there. How to separate the library from Excel, bring it into the cloud, and then still keep Excel running and communicating with the microservice in the cloud.
I think it was very interesting to see that the community, a large part of the community seems to have understood the limitations of the core quant business. I think after the crisis, the main events were mainly focused on how can we build better models, even larger models, how can we add more complexity, how can we capture certain effects that have hit us in the crisis. And I think today people seem to have reached a point where they say, okay, we cannot explain the world, we will not be able to model all the risks that are out there, and so let's just accept that there are certain limitations. And
So firstly, I believe there is some advantage to US banks currently because of the capital and tax rules that apparently will be implemented. But overall, I guess this will be a very short game. In all, it seems to be quite troublesome, the uncertainty in political and economical situation. So I think we will see lots of losers, not only in Europe but also in the US.
Actually, I don't think they help in each and every point. They are intended to help on a higher level, so to say. On the other hand, the regulation became rather complex in terms of any kind of requirements which were not such detailed in years before, and I think it would be more helpful if we have less detailed regulations.
Because I don't understand why if I have a derivative contract with you, why should I pay? Why should the value of the derivative contract be adjusted by a cost that you are making? So that doesn't make for me.
And me as a math student, I think the intellectually challenging atmosphere where you have the like university development research style connected to the fast moving developments of an international banking industry is as well as interesting and challenging at the same time.
Yeah, so basically the idea and what I thought when I was working at Murex, in a financial software company, was that I found out that actually what was interesting is that the quants were reading a lot of papers and doing a lot of research on the side, and I wanted to know more about that. And